This is the Financial Survival Network. Now more than ever. The Financial Survival Network.
And welcome. You are listening to and watching the Financial Survival Network. I'm Kerry Lutz. It's 3/8/21. Are we seeing sector rotation in the stock market? Home builders on fire, real estate on fire. Got to confess, I just got an accepted offer on a home here in northern Palm Beach County. And no sooner did my offer get accepted, 9 other people literally are at the door tried to get in. But I beat them all, so lucky me. And, well, we got bonds, no bonds for you. And what about the $1,400 Robinhood subsidy check? And my goodness, precious metals, it's just falling out. Our good friend, founder, and chief market strategist of the Technical Traders, Chris Vermeulen, is with us now. Chris, welcome back. So what do you make of the latest market vicissitudes?
Yeah, well, thanks for having me on the show. Yeah, it's a wild market. I mean, it's been a really volatile week and a half in the stock market. You look at the Nasdaq; it fell about 10% from the highs, and it continues to flounder. It's stuck under the 50-day moving average. A lot of damage was done to the Nasdaq, to the tech sector. When you look at clean energy, you look at the EV market. Just a lot of damage was done. But it's interesting because the other side of the equation, when you go and you look at the small caps, the Dow, the SP 500, they're actually holding up very well and moving higher, really bucking the trend compared to the NASDAQ. So there's a huge sector shift, a big kind of mass movement of everyone moving out of technology, thinking, I guess it's had its run. And now people are kind of flocking into the safe haven. Where are they going to go and find value? Something that hasn't run up nearly as much and has room to run. And really, that's like the small caps and the Dow, the energy sector that we're looking at.
Yeah, the energy sector has been hot. If you remember, just a couple months ago, there was talk of ExxonMobil doing the unthinkable, laying people off, cutting their dividend yield. And now all that talk seems to have vanished with $65 a barrel oil, which means that the shale oil fields, if they're allowed to in the U.S., can start pumping again. Shut-in production is going to come back online. And maybe the U.S. will be, once again, energy self-sufficient. What do you think of these energy juniors and micros? We saw microtech biology stocks just explode to the upside. You think we'll see something else similar in micro cap energy stocks?
I think so. I mean, there's so much money out there searching for the next hot move, and the energy sector is on fire. I mean, I think a lot of the micro caps for in the energy sector have already started pretty big runs. I actually think the energy sector, it's getting a little overheated. I think a little pause or pullback would be a good thing. But overall, I mean, it's one of the leading sectors right now. You really do, if you're in the market, energy is the way to go. When you look at oil, natural gas, all those companies. So I like that sector. It's leading the way. That's where the money is really flowing right now. So, and you got to follow where the money's going. So, yeah.
Okay, so bond market is a totally different picture, though, isn't it?
It is. I mean, it's bonds away. It's just going straight down. It's, no one's interested in buying them. There's obviously fear creeping in, and with investors not really trusting the U.S. bond market, not getting the yield they want, and bonds just continue to fall. And that's a kind of a sign that I think the stock market is really, really frothy. Sure, money's rotating out of tech and we are seeing money come out, but it's piling into just the other side of the stock market, from tech over to like industrials and, the big kind of big stocks that are for the economy. So the money's not really coming out. Investors are actually more bullish now than ever, and they're not buying any defensive positions in bonds or anything like that. So the fact that bonds are going straight down and we're just seeing money come out of one sector and it's just going over to another stock market sector is a sign that I think we're getting really close to a much deeper correction in this market. But you can't buck the trend. You got to just stay with the markets here until the actual trend reverses. But I think there's going to be a huge play in bonds. going forward once it does find a bottom.
Yeah, no doubt. Well, look at rates. Unheralded 1.65% on the 10-year, and everybody's bemoaning this. And a few short years ago, 1.65 would be, wow, they're really turning on the money spigots.
Mm-hmm. Yeah.
So interest rates, what's your take?
Yeah, I don't do too much around the interest rates. I don't think things are going to change a whole lot. I mean, obviously, we've seen mortgage rates really jump in the U.S. in the last couple of weeks. I mean, jumped over 3%. I think this market is getting really long in the teeth. As excited as everyone is, there's going to be a pretty nasty ending when the music stops, and if rates keep going up. There's a big delay in real estate in rates. Most people have a 3 or 5 year mortgage. Just like when we saw the '08 crash, it took a couple more years for the real estate market to fully crash because people don't need to renew their mortgages for another, 2 or 3 years on average, and people won't have jobs. They'll have lower income. They won't get the financing they need. Rates could be higher. All these things. So there's going to be a big delay. So, I mean, I see the music coming to an end, but I really don't see the whole rate and real estate market, topping out anytime soon. There's a very big delay. And that's why we're seeing it still take off right now. We look at the real estate ETFs and home builders, and it's just a feeding frenzy right now still of piranhas out there buying up everything they can. And, you can see the top coming, but we don't know where it is, and you don't want to jump into that water and bet against it yet.
Hey, and let's not forget there are really 11 million people who are in arrears on their mortgages, and through government policy, largesse, whatever you want to call it, their day of reckoning keeps getting put off into the future.
Yeah.
There's probably no way that they can pay back the arrearages. There needs to be a workable solution that this amount, their mortgages get extended and the amount just gets added to the principal, and we call the whole thing a wash. But government isn't usually so practical. They'll come up with a whole department and a lot of bureaucrats and a lot of jobs to accomplish the very same thing. So we're calling the $1,400 stimulus check the $1,400 Robinhood subsidy check. That's going to have an effect on the market. You're talking tens of billions of dollars flowing in. One thing, we've seen record inflows into the market, and yet we've seen declines. That's something that's really unusual, isn't it?
Yeah, we've got really mixed signals. I mean, this market is very choppy. There's huge flows of money coming out. There's also big flows of money going back in. It's going from sector to sector. That means there's volatility. That means there's uncertainty. There's a shift taking place, and just a matter of when this upward momentum runs out of steam. And obviously, the stimulus plan, that's probably going to bump up the markets. We're going to see lots of money flow back in, and it'll help support it for another push. Maybe that's why we're seeing a bounce in the last 2 trading sessions here for the Dow and the small caps. People are piling into these fast moving stocks and chasing the money. But I mean, we're not in the clear yet. I think the stock market is very close to still actually having another pretty big leg down before we start to go higher. So I mean, we've been sitting on the sidelines for about a week and a half, 2 weeks, just letting this market shake itself out, trying to get a gauge of where is the money actually going, and is it actually staying there, or is it just waves of greed and fear, or we want to get a gauge on that. So it's best to step back sometimes, and once this dust settles, potentially in 1, 2, or 3 weeks, we'll step back into the market in the leading sectors or commodities, wherever that is going to be at that point, and then we'll get involved. Whether it's at a higher price or lower price, it doesn't matter. We want to avoid this chop because it's very sporadic, it's very random, and the moves are big, and there's no point in taking a big haircut trying to get in on this type of volatility.
Yeah, big moves equal big haircuts for sure. And hey, so what about gold and silver? They've again turned into the redheaded stepchild, if you will.
Yeah, they're still out of favor. We've been bearish on it for quite a while, months and months, and I still see gold picking up speed and actually I talked about it this morning with subscribers. I think gold could have the bottom fall out of it, and it could fall quite a bit still. Somewhere around 1640 or so per ounce very quickly here. It's making a little bit of a running a running consolidation over the last 2 weeks, which just means we're going to probably see another 3 or 4 days of, downward price and a washed out low. Silver still has a bearish pattern. I think it's going to 24 an ounce, the continuous contract before it finds a bottom. But they're getting long in the teeth. They're getting oversold. It's just, you got to let this momentum finish. There's no point in trying to pick a bottom because you don't need to ride through that pain. So again, we're just on the sidelines watching the chaos, and we'll get in when the dust settles.
So get in when the dust settles. And so if you're in it already, do you get out? What do? You taking your hit already? What's the choice?
Yeah, depends where you are. Obviously, the majority of people have been very tech heavy, like the EV market and solar, clean energy. So people have probably taken most of the hit already if they're not out. Obviously, if you're in like the small caps, the Dow, or energy, you're moving up. You've been making money while the rest of the other side of the market's been going down. So if you're in the energy sector, I still really like it. I think that's the side you can stay in. But if you are in tech or Nasdaq, you really do need to be in cash if that's your type of focus, because right now I still think it has more downside, and it could happen very quickly.
Do you think we've gotten to a tradable low yet in gold and silver, or you just think there's a little more to come?
I think there's a little bit more to come. I don't think there's a huge rush to pile into it. I mean, they're both forming very long-term, massive bull flag patterns that will take months and months to unfold still, and then rally for several months. So I don't see any point in trying to jump on the bandwagon when I still think it's got a bit more downside, and then it's got to build a base and a launch pad, and then changes momentum from down to up. So I'm in no rush to jump into metals. When the tide changes and I see it going up, that's when I'd be interested in getting into those.
Yeah, well, there are times during the year, when the metals really don't do much. They kind of just are trendless to lower. And then all of a sudden, these certain seasonal attributes kick up, and then there'll be a catalytic event that goes with it. And then all of a sudden they go parabolic, and then they settle down for the next leg, I guess. And it seems like we're in that now. It's kind of listless, a little discouraging to precious metals investors, but the key is don't get emotionally attached to any stock, any sector. And that way you'll be objective, and you'll be able to switch when the switching is good. And
the dollar's playing a big part of it right now. We've seen a strong move just in the last 3 sessions alone in the US dollar. That's telling us there's fear. When there's actually fear among big investors, we tend to see the dollar go up. So if big investors are liquidating out of tech and they're moving to cash, which is we're seeing the US dollar really just start to kind of drive up. If global money is kind of moving to the dollar, that's a sign that big smart money is shifting, and they're getting out of risk on. Well, the general public, I think, is piling and sloshing around from sector to sector in stocks. Big money seems to be moving into the dollar, just like we saw during the COVID crash. We saw the US dollar rally like 11%, while the rest of everything else fell. So I think the smart money is getting into cash, and that's what we've been doing. The charts are saying move to cash. Something bad could be happening. There's no point in holding through this. And that rising dollar is tough on metals. So, and that's also, a sign that people don't want to buy bonds. They just want to go to cash. They literally think cash is safer than bonds, and that is not a good sign. So the music's coming to an end. I think we're gonna have a deeper correction, but is it now? Is it 10% higher from here where the top gets put in? I don't know, but there's mixed signals, and the sidelines is a perfectly good spot to watch from.
Yeah, when there's uncertainty, when markets are crashing, the sidelines are a great place to be. And I guess that's about it. Hey, just tell us where to find you and what we'll see on your site.
Sure, yeah. So at the technicaltraders.com, I post my analysis every morning, a video recapping on all the major assets and sectors and commodities, and I kind of walk you through what's going on, where our positions are, what we're looking for, and on the website we're also teaching how to trade the band strategy, which is to find the leading sectors. So when this stock market gives us a new buy signal, I'm teaching for free in a webinar exactly how to find those leading sectors and then how to manage those positions. And what's really interesting too is we do options. So in a market like this where volatility is increasing and there's really low probability of picking the right direction, we also trade options, and you can do non-directional options trade, selling premiums. So it doesn't matter which way it goes. We just collect a premium as time decay, theta just kind of eats away at people's accounts, and we're on the other end of that, kind of collecting those premiums. So there's ways to trade this market. If you're not directional, you got to move to options or go non-directional, and just more or less you're selling premiums to uneducated options traders who are thinking this is going to move big, but you're really just taking their money, because 90% plus of options expire worthless. And if you're the one selling those options, you get to pocket that premium every month.
All right, makes a lot of sense. Any questions for myself or Chris? I will follow them up to him, forward them off to him. Just send the email to kl@kerrylutz.com. Sign up for the newsletter, financialsurvivalnetwork.com. Chris, always a pleasure. Good luck, and we'll see you at the other end of the cycle.
All right. Thanks, Kerry. Take care.
Now more than ever, the Financial Survival Network.